Joining us now to discuss the market outlook for 2024, Jurrien Timmer, Fidelity Investments Director of Global Macro. Jurrien, Happy New Year. Good to see you. You see our survey results here. Biggest worries, 23% say stubborn inflation, 21% say 23% stubborn inflation, 23% problems with commercial real estate, 21% slow economic growth. How about your list of worried items for 2024, Jurrien?
Well, you know, that survey describes perfectly kind of the roller coaster of tail risks that investors have to navigate, right? And we did this, of course, this year. If you think of the distribution of all outcomes, it's a bell curve, right? The middle is Goldilocks, where we seem to be right now. The left is a recession. The right is higher interest rates. And we started the year, fearing the left curve. Remember the inverted yield curve, and that was going to be the other shoe that was going to drop in 2023 after the rate hikes in 2022. And then by the middle of the year, we were worrying about, not necessarily overheating, but higher rates, the 10-year pushing 5%. And now we're back in the middle. And so your survey perfectly encapsulates how investors have to traverse around that bell curve from one extreme to the other. And, we're in a good place right now, but I wouldn't dismiss the possibility that in 2024, we're going to be kind of riding that bell curve yet again.
Yeah. Sarah and I were talking about another risk, which is fewer rate cuts than expected. The Fed's, we're anticipating 150, 160 basis points in rate cuts in 2024. That's, 6 rate cuts, essentially. If inflation is a little bit higher, the economy is too strong, that may not materialize. To what extent is that priced into the market, and would that be a problem if it didn't happen in the sequence that the street seems to believe it's going to happen?
Yeah, so I think it makes sense for the Fed to give back a few of its rate hikes in the same way that Alan Greenspan did in 1995. You remember those days, Bob. Greenspan hiked rates 300 basis points in 94, gave back 75 in 95, and we had a soft landing, one of the few in history. And the market, of course, rocketed off 37% in 1995 and went up for, I think, 5 years straight, I believe it was. So maybe the market is hoping for a replay of that. And I think a few rate cuts make sense because inflation has fallen. I think it's likely to be sticky at around 3%. And as you mentioned earlier, Supercore is still around 4%. So I think those last 100 basis points are going to be hard to get. But with inflation falling somewhat, the Fed can give back some because its spread over that inflation rate then starts to go up in terms of where the Fed is. But I think 6 or more rate cuts, I think, is quite unrealistic unless we get a recession, and then we have other problems, because then your earnings side is not going to hold up, and then the market will have some issues. But I think a few givebacks make sense. But the market being the market, the market's like a spoiled child. It gets a few and it wants more, and that's a very typical situation that we're finding ourselves in right now.